Hello guys, now let's resume the last chunk of this cash flow statement chapter which we are covering. So this is the fourth video and the last video in which we will be completing this entire presentation of 15 slides. So let's start. So first of all, the heading is over here that how to find net income when it is not given. So sometimes what happens in the question, the net income is not clearly stated. In that scenario, what do we need to do? We need to analyze the different figures that are given in the question, and on that basis we need to derive the net income. Acha, how to identify, how to derive this? Let us look into this. So what happens in some exam questions, net income is not directly given, but still you need it for the indirect method. Why? Because to find out the cash flow from operating activity, if we are using indirect method, in that the beginning figure is net income. Okay, so we need to find out the net income using the concept linked to the retained earnings. So net income increases retained earnings, dividends decrease retained earnings. Now what is this? Let us understand. Now first of all, whenever we have an income statement, we will get profit, right? So this profit, some of it is distributed as dividends, then some of it is kept aside as retained earnings. It's not distributed among the shareholders. So what happens whenever we have income? So net income is gonna increase your retained earnings, and if we are giving out the money to the shareholders, we will give it out from this. So this is gonna be what? Reduce the retained earnings. So how do we calculate the net income? Closed retained earnings minus opening retained earnings plus dividends. Let's have an example for this. Okay, so the question in it is given that the opening retained earning is 2 lakh, closing retained earning is 2,80,000, dividends is 50,000. So opening retained earnings minus closing retained earnings plus dividends will give you 1,30,000 of net income. So whatever increased RE after removing the dividends is the profit. So in the exam, always check if dividends are given. If it is given, we need to add it back. If ignored, the answer will be wrong. So always remember, if dividends are given, we need to add it back in order to arrive at the figure of net income. Why? Because dividend is a part of net income. From where does dividend comes? Dividend is a portion of net income. So that's how we need to find out the net income. In order to find the correct value of net income, we need to add it back. Now, this is just a basic overview of the direct versus indirect method which we have already covered. Let's have a look. So first of all, what are the common points? Both methods give the same final cash for operations. Then only presentation is different. What are the key differences? First is the direct method, next is the indirect method. This adjusts each income statement item. Direct method adjusts each and every line item. Indirect method starts with net income. It shows actual cash inflow and outflow. It adjusts it to convert profit into cash. Then example, cash received from customer, cash paid to suppliers, these are all what? These are adjusted. In this case, indirect method, it only shows the net cash figure for the operations, that is for the operating activity. Then simple table comparison, tabular comparison. We have direct method, we have the indirect method. What is the starting point for the direct method? We take each and every line item of the income statement. So revenue and expenses. Then we have the net income is the starting point for the indirect method. Then in this, the focus is on actual cash flows. In this, focus is on adjusting the profit to cash. This is a detailed presentation, this is a summarized version, and the final answer is same for both direct and indirect method. Okay, so direct method shows the cash directly, indirect method converts profit to cash. As you can see, we are converting the net income to the cash. So what is the difference? Difference is only how we present, not in what we calculate. Okay. Investing and financing activities key rules. So cash flow from investing activities includes cash outflows and inflows related to the long term assets. such as PP&E and investments. Then questions often focus on sale or purchase of fixed assets. Some required information may be hidden in additional information. Only actual cash paid or received is reported. Now what are the treatment? Treatment is purchase of asset is a cash outflow, because asset is coming in, you are giving cash out of for that. So that is what is termed as a cash outflow. Then sale of asset is a cash inflow, because cash is received only. We do not report gain or loss book value separately. However, book value and the gain loss may be needed to calculate the cash received. We have one example with which this concept will be a lot more clearer to us. We have been given the cost of an asset is 20,000, depreciation on it is 12,000, and gain on sale is 5,000. Now how do we find out the book value of the asset? So in the balance sheet, how do we present an asset? Asset minus depreciation. That is the value of the asset. So that is the book value. Okay, so book value of the asset is the cost minus accumulated depreciation, that is 8,000 bucks. Now how much is the cash received? They are saying gain on sale is 5,000. So 8,000 plus 5,000 will become 13,000. Now investing cash inflow will be 13,000 bucks. Gain rupees 5,000 is shown in the investing activity. The entire 13,000 will be shown. This gain will not be shown in an operating activity. Now we have the adjustment in operating activities in the indirect method. So gain is already included in net income, but it is not an operating activity. Therefore subtract gain from the net income. The cash related to this gain is already shown in the investing activities. Then cash flows from financing activities, meaning financing activities involve raising funds, repaying funds, issuing shares, borrowings, loans, and repaying debts. So it is same as investing, only the actual cash amount is considered. We need to ignore the book value and gains and losses. However, they may be needed to calculate cash paid. Example, redemption of bonds. So in this case, book value of the bond has been given as 1 lakh. 1 lakh. The cash repaid is 1,05,000. So financing cash outflow will be 1,05,000. We are ignoring the big value, we are ignoring the gain or loss, only cash paid is reported over here. Then important rule of not netting, which we have already covered. So what happens that we do not combine inflows and outflows. Each of this must be shown separately. So net cash from equipment is 3,000, cash paid to purchase the equipment is 10,000, cash received from sale is 13,000. Both are shown now separately. They won't be combined and shown as 3,000 inflow. This will be wrong. Now, disclosures, important point. One of the topics that can be tested for your CMA US. Now there are transactions, there are different kinds of transactions which do not involve cash, but they are gonna affect our assets and liabilities. So what happens, they are disclosed separately in a schedule or a note. Now what are some examples of non-cash investing and financing activities? Debt converted to equity, borrowing to purchased assets, lease transactions, purchase or sale of using stock, assets received as a gift, and exchange of non-cash assets and liabilities. Now why disclosure is required? Because these transactions can significantly affect the financial position, and it is important for investors to understand. For example, if a company buy asset using shares, ownership of existing shareholders gets diluted. Presentation can be narrative or a summarized schedule. So that's why it's important for us to disclose these kinds of transactions which are non-cash in nature, but they are gonna affect the value of our assets and liabilities. One special note over here we have, that stock dividend is not included in SCF and not disclosed as non-cash activity. Reason, it affects only equity, not assets or liability. Because again, stock dividend we have already discussed in the previous second or the third video, that what is stock dividend? Instead of giving out the share of their profit of the shareholders, they are entitled to receive, they have their right to get some portion of the shares, right? So instead of getting that, what happens, instead of giving them the actual cash, the companies, they give them the dividends, they give them as stocks. So that is termed as the stock dividends. So they are not disclosed as a non-cash activity because it is only affecting our equity, not assets, not liabilities. Very important point to note, guys. Please remember this one. Now, cash equivalence policy disclosures. What is the requirement? Company must disclose what it considers as cash equivalents. So cash is physical cash plus what is lying in our bank, and cash equivalents are short-term investments, the maturity of which is less than 3 months. Okay. Now, policy changes treated as change in accounting principle and requires restatement of previous financial statements. That means if you are changing the way you are considering your cash equivalents, like suppose you are previously considering short-term investment as a cash equivalent, but now you are not considering it as a cash equivalent, then you will do what? You will be accounting it as change in accounting principle and you need to restate your financial statements. Then disclosure of cash, interest and income taxes paid. So we have indirect method and we have direct method. So indirect method, interest paid and tax paid are not separately shown in statement of cash flows, therefore separate disclosures are required in separate schedule. So interest disclosure includes net of capitalized interest, accrued and accelerated interest on zero coupon bonds and discounted debt instruments. So these are the indirect method. Whenever it is used, we need to present the separate disclosure is required for IIT. We remember we discussed this in the first video. Then direct method is used, then no separate disclosure is required. Reconciliation of net income to operating cash flow. Reconciliation is mandatory. Net income to cash flow from operating. Reason, profit is based on accounting, cash flow is based on actual cash. They are not the same. What happens in the direct method? Operating section shows actual cash flows and reconciliation must be shown separately outside the SCF. In the indirect method, it starts from the net income, adjusts for non-cash items, gains, losses, working capital changes, and reconciliation can be within the statement of cash flow or in a separate schedule. Now, some of the benefits and limitations of the cash flows, and with this we will be done with this chapter. So benefits, that it shows the real cash picture. That means profit is a theory, cash is the reality. Why? Because at the end of the day, when we have to spend money, we will not look at the profits, we will look at the cash. So that's why it gives us the real cash picture. Then it explains to us that profit is not equivalent to cash. Profit is something different with what is actually lying with the business in the bank account or maybe in their cash box. Then it shows the investing and financing impact. Why? Because we have two separate activities, investing activities and financing activities. Then assesses need for external financing. Then if operating cash flow is negative and financing is positive, company depends on external funding. Then helps lenders check the repayment ability. Why? Because the lenders, when they want their money back, suppose I have taken loan from someone and I want my money back, what I will do? I will pay them back in cash. So they will be interested in knowing the cash balance. Then it helps investors assess the dividends, because dividends are paid in cash and they are not paid in profit. Coming to the limitations, it only shows the cash, not the full picture. That means it does not show the profitability or the full financial position. That means it only talks about cash. It does not talk about the income statement or the balance sheet. Okay. Now, needs support from other statements. SCF does not show unpaid liabilities or full profit details. Example, positive cash flow, but balance sheet shows high outstanding payables. risk exists. Why? Because statement of cash flow will not show in itself what is outstanding, that is what is our liability. It will need support of other statements like balance sheet or income statement. Then indirect method is less clear. Indirect method does not show actual cash received or paid, only adjustments. Indirect method explains but doesn't show clearly the actual cash received or the bill paid, because it has the adjusted values. So yeah, that's all about the statement of cash flows in this last slide. I will leave it for you guys to understand it yourself, because this shows us how this topic can be tested in exam, what are the common question types, then any examiner trips or common twists you can watch out for, what are the mistakes that students make in the examination, and what type of questions we can expect, and what are the key terms to remember. So these are all the things. I will leave it for you guys. Anyways, I'll see if we need to cover this particular thing as well. I'll make a video on this last slide as well. Thank you so much guys for staying with us, and yeah, hope you liked the video.